Hey friends, in this video I'll share with you a strategy that I like to use using options to make huge profit from stocks like Tesla and Nvidia without risking a lot of our capital. Now let me show you how it works. You can see on the chart right here, Tesla is a crazy volatile stocks and it has huge gaps, especially during earnings. Now, this is very useful during earnings season, but do not enter Tesla right before earnings. Let me explain to you why. Right now, we can see that Tesla is going to report earnings in 1 week's time, and the implied volatility of Tesla right here, the percentile is 97%, means that it is almost all-time high. 100 percentile is the highest ever, 97 percentile is extremely high. So as we go closer and closer to the earnings date, this implied volatility will become higher and higher all the way to 100 percentile. What this means is, if we purchase an option right now, we are paying a huge price to buy the options because there's a lot of unknown, there's a lot of volatility. You are required to pay a huge premium to guess which direction Tesla goes. Instead of doing that, a strategy that we use is we wait for after the earnings is announced and the volatility crash. Let me give you an example using Adobe because they've just announced their earnings. You can see Adobe right here similarly has huge gaps, and they have reported their earnings about 1 month ago on 13th of June, and right now it's 15th of June as I create this video. So within that 1 month, one thing that's very interesting is we can see that Adobe implied volatility percentile of the options is only 8 percentile, which means that it is extremely low. So here is an option strategy I like to use after earnings has been reported and the volatility crash. I will establish what we call a straddle. What it means is we are going to buy a call and a put for Adobe, and we are going to buy it and last until the next earnings and beyond. So Adobe reported their last earnings on the 13th of June. So about 3 months, they'll be in September. I'm going to purchase a straddle all the way to October. What this means is I'm going to buy a 180 call at $12.55, and this call will make money when Adobe's price increase. So if the next earnings they have a gap up, that's where my call will make money. At the same time, I will also buy a 180 put at $10.83. So if the next earnings Adobe gap down or moves down a lot, that's where I will make money as well. The worst case scenario for this particular strategy is when Adobe doesn't move. Looking at the risk graph here, you can see at the expiry date, which is the 18th of October, Adobe must move substantially. Right now, the price is $179.15. It must go beyond $203 for me to start to break even and make money. And the higher it goes, the more profit I gain. 4,000, 5,000, 6,000, and unlimited. Same thing, if it doesn't go up, I need Adobe to go down below $156. That's where I'll start to make 1,000, 2,000, 3,000, all the way until Adobe goes to zero, which is unlikely by the way. A few key things to note. Take note that this is the current price, and for it to move to the break-even, if you look at here, for it to move to the break-even point, Adobe need to move by about 13%. Has Adobe moved by 13% since the last earnings call? Let us look at some of the historical data. Looking at the past two earnings announcement dates, 13th of June and 14th of March, we can see that the earnings move is 14.5% and 13.7%. Now, this is not very comforting because if it only moves 13.7% or 14.5%, our profit is going to be very little and is not worth the risk. For this particular options, we are putting up $2,337.50. This is the full premium paid. The good news is this is the total amount that we can lose. Now, let me share with you why this strategy has a high chance of winning. Do remember a few things. Number one, we do not have to wait until the expiry date. Instead, what we do is we exit upon after earnings is announced. Because if we wait too long, the volatility will go down again. Hi my friends, this is a shout out to you if you have not joined my newsletter. Subscribe to my newsletter for free, and every single week we talk about topics like how to beat the market before everyone else, going to specific sectors and stocks. Now, a lot of my readers of my newsletter have replied saying how this newsletter have changed their life and they are shocked why am I not charging anything. The reason is this: I want to give all this information out for free so that you can build wealth and potentially give wealth to change the world together. Put the link in the description below. Remember to subscribe to the newsletter, and I'll see you there. So instead of waiting until the 18th of October, we can aim to exit somewhere around, say, 14th of September or 13th of September. We can exit somewhere, say, about 13th of September, which is the estimated date of the next earnings announcement. If we exit earlier, you can see that the break-even point becomes a little bit closer to current price. Reason being, when we exit, each particular options, both the call and put, still has time value. Now, instead of needing it to move 13%, we need it to move about 11% up and 11% down. But there's still one more thing. Let me show you this thing called implied volatility. Remember, Adobe announced their previous earnings on the 13th of June 2024. Let me show you how this impacts the implied volatility of the options chain in Adobe. Looking at the past historical data of the options chain, this is the implied volatility of the options for each single day. At the date of recording, it is 15th of July. We can see implied volatility is about 24.84%. If we scroll down, you can see at a certain point, Adobe's implied volatility for the options is in the 40% range. When does this happen? It is nearing the earnings announcement date. Remember, they announced earnings on the 13th of June, and on 13th of June, the implied volatility was 47.32%, and after they announced, it dropped to 24%. So what it means is, as we hold the particular straddle, there is a chance that the volatility will increase as it goes nearer to the earnings date. So at any point in time, looking at the risk graph again, if the implied volatility slightly increase, you can see that the break-even point becomes even nearer, less than 10%, about 7% on each side. So the optimal time for exit is once they announce the earnings, we immediately exit as the price move. We may take a profit, we may take a loss, but the chance of winning in stocks like this, in Adobe, in Tesla, in Nvidia, the price movement is likely to spike because these are stocks that the whole entire world is looking at right now. Tesla, for obvious reasons, for their electric vehicles movements, Nvidia because of AI, and same for Adobe because of the AI craze. So you can see, using options, we can structure our gameplay to increase our chance of winning while reducing risk. And remember, regardless which option strategy you use, it is very important to position size and make sure that if we lose, that is the maximum loss that we will take, and we must be able to afford it. If you'd like to learn more about option strategy, do comment below what other option strategies you would like me to go deep dive into, what other stocks you want me to look at, and remember to subscribe and like this video. I'll see you around, and remember to invest safe.